Hello, everyone. Welcome back to the Market Chat. My name is Richard Moglen, and joining me today on the show is Jonah Lupton, entrepreneur and growth stock investor. Jonah, thanks so much for being here. Welcome to the show.
Thanks for having me. I appreciate it.
Yeah, no problem. So why don't we get started with some background questions? And I always like to start things off by asking you, how did you get started with investing, and what were some kind of key learning moments?
So I graduated college 2002. I started working for Morgan Stanley right away. So I jumped into the business at 22 years old. Didn't really know much. I mean, obviously, when you take classes in college, you learn a little bit about the markets. My father had actually been in the markets. He'd been a financial advisor, a stockbroker for probably 25 or 30 years at that time. So I learned something from him. But at the end of the day, you still learn most of what you know just in the business, right? So 2002, started working at Morgan Stanley, was there in their wealth management and private client group for a few years, moved over to Smith Barney, and then I went to a private trust company in Boston. So from 2002 until about 2011, I was working in the industry in wealth management, managing portfolios, a variety of strategies from balance to value to growth, dividend paying, even managing some fixed income along the way. But, as you grow your book of business, and I don't know how many people actually know this or not, if you're in the wealth management business, you get paid a fee based on your assets under management, your AUM. And if you really want to, increase your income on an annual basis, you need to grow that AUM. Hopefully you're going to get some performance from the market, right? That takes your, overall AUM from 100 million to 110 to 120, et cetera. But you need to keep adding accounts along the way. And the more time that you spend in the office managing portfolios, the less time you spend out of the office meeting with new clients, meeting with CPAs and attorneys. So, you need to realize that you're better off handing that money off to a PM or using separate account managers, and then being more of like an asset gatherer and going out there and spending more time looking for new assets to bring in. And I didn't like that. I didn't like, going out there and having to beg for referrals and going to all these networking events and, sitting on the boards of nonprofits. It's time consuming. I didn't enjoy the networking aspect of the business anymore. I wanted to be a portfolio manager. Like I just wanted to sit in the office all day and do research and trade stocks and look at charts. That's what I actually enjoy more. So, after 9 or 10 years of doing it and kind of, having that struggle between the retail side and then kind of wishing I'd been on the institutional side, I decided just to walk away from the business and get into some startups. So I actually launched my own tech incubator, brought in a development team. We were actually, building our own startups and then working with other clients to help them build their startups. Did that for 5 years. And then I actually started a company called SoundGuard, where we created a soundproofing paint for hotels and apartments. That was going really well. We were going to have a phenomenal year this year and a lot of projects lined up for next year. And then obviously the pandemic hit, wiped out the hotel industry. The pipeline basically disappeared overnight, lost $2-3 million of projects. And I'm still not sure what's going to happen with SoundGuard. Most likely I'll bring in a new CEO to run the company because I got to look forward. And in my future, I see myself getting back into the industry full time. And rather than just running my own portfolio, which is what I do now, running money for clients or running some sort of a fund or an ETF. But I just love the business too much to walk away from it again. So the paint industry is probably in the past. now I'm full-time financials, I guess, or full-time investments.
Yeah, very cool and very disappointing about your business. Does being a business owner, a small business owner, has that changed your kind of outlook and how you approach the market itself, or not really?
I saw the question that when you sent it over to me, and I was trying to think if my mentality has changed in any way. Probably not. I think my investment style now is part just the types of companies and industries that I'm most interested in and ambitious about. But also, I did manage client money through the financial crisis 10, 11 years ago, and I remember it fondly, and I still have those scars. So I remember, what happens in a bear market and how bad it can be and how long it can last. Now, clearly, we didn't see that sort of a bear market again this year because the Fed came in with their trillions of dollars and their bazookas and blasted it all over the credit markets and into our bank accounts to help stabilize everything. I wish they had been that proactive 10 or 11 years ago. Maybe Lehman Brothers and Bear Stearns would still be around. Maybe Merrill Lynch wouldn't have sold off in a fire sale to Bank of America, and maybe all of our preferred stocks wouldn't have gone to zero. But it was a wild time 10, 11 years ago, and trying to manage client money. And, clients are paying you to be invested more or less. And so you feel like, and you never know where the bottom is going to be. So you can't, just sit in cash and try to wait it out because, that's just not the right way to manage money. So you keep meeting with your clients and talking with your clients and telling them, be patient, think about the long term. We have a strategy, you're properly allocated, blah, blah, blah. But, as they see their portfolio going down every month, it starts to fall on deaf ears. So it just a combination of me kind of burning out back then and wishing I had gone the institutional route, hedge funds, running money for a big foundation or endowment, rather than running money for retail. But I still learned a lot.
Yeah, absolutely. So why don't we get into your investing strategy? Because it's good that I'm having you on, because a lot of my previous guests have been more swing traders, position traders even. So my first question, I guess, is how would you classify yourself? Are you more of on the investing side, trader? How do you describe yourself?
So I'm a little bit of both. And it's going to depend on, what the market's giving me to work with. So I do consider myself more of an investor than a trader, but it's probably 2/3 investor, 1/3 trader. So I do post my portfolio on, I have it on a Google spreadsheet, which is actually pinned to my Twitter account. So anybody can look and see what positions I own. I update it at the end of every day. So I do have my core positions, which are typically over 5%. They'll get as big as 8 or 9%. And then, a couple months ago, I think I took Tesla up to 15%, but that was, and then as it rallied, like I hoped it would, I trimmed it back down under 10, and I actually sold all my Tesla this week. So, I try not to get married to any of my stocks. If they do what I think they're going to do and they reach the point where I just feel like they're beyond frothy, or the upside over the next 3 to 6 months is just minimal compared to some of my other positions, mm-hmm. I would rather sell it, pay the taxes on the gains, and, reposition that capital into some of my other holdings that maybe, are about to rip, or, came back, recently found a base on a moving average, like a couple of my stocks did this past week. So I have the core positions, C Limited, CrowdStrike, Square, etc., and then I'll trade around them. But this past year, Tesla was very good to me. Peloton was very good to me. Etsy was very good to me. They're no longer in my portfolio because they're up 8, 9, 10x in the past year. And I just feel like the valuation has gotten to a point where it's just, I hate to use the word stretched, but yeah, I have to look at the fundamentals for 2021 and then put what I think is a fair market valuation on that company. And if it's already close to that, then, and some of my other positions I think could rally 30, 40, 50% in the next year. That's where I'm better off having my money. So, and if those stocks that I sold out, happen to pull back 10, 15, 20%, I'll definitely consider getting back into them.
Gotcha. And overall, what would you say your strengths and weaknesses as an investor are?
So I think up until the last couple of months, one of my biggest weaknesses was charts, technicals, but I think I've gotten better at it. Thankfully, there's like TrendSpider and MarketSmith make it really easy. Mm-hmm. I just think the software has gotten so much better in the last year or two that you're doing yourself a disservice if you don't try to integrate technicals into your strategy. So I do use, the Bollinger Bands, the moving averages to try to help me determine when to start trimming a stock or when to start re-adding a stock or starting a new position in a stock. I know we're going to go into the charts in a little bit, but Futu is one that I'm proud of right now because it bounced 8 or 9% today. But I started buying that a few weeks ago thinking it would bounce off the 20-day. And it blew right through it and then came all the way back down to the 50. So I kind of felt stupid for a couple of weeks as I was losing money on it. But seeing what it did today, hold the 50 and got a nice bounce, I feel like that's where the charts help me out. So, rather than, a week ago, just cutting my losses and running out of the stock, and then I would have missed today. So.
Absolutely. And it seems like all the stocks are definitely growth oriented. Are there specific themes within that you're focused on, whether it's EV, semiconductor, social media? What kind of themes are you focused on for this year and also going into the near future?
So I think 2020, I was definitely more, thematic focused because of the pandemic and trying to figure out what sectors or what niches of sectors would benefit most from the pandemic. People stuck at home, people working from home, et cetera. A lot of these trends got pulled forward a few years.
Mm-hmm.
So I was, huge on e-commerce, huge on digital payments, huge on online gaming. But those stocks have rallied 200, 300, 400%, in some cases, 700 or 800%. I mean, Fiverr is scaring me. I still like Fiverr. I mean, the growth numbers for this year still look great at 40, 50%. But, the stock's up, I think, 8 or 9x in the last 10 or 11 months. So, just like, I remember the dot-com bubble. I mean, not that these stocks are necessarily the same thing, but I mean, I've owned so many stocks over the years and I've watched them run up and then run back down. And I don't want to see that, I don't want to play that game. So sometimes you just have to be a little bit more cautious and, take your wins when you can get them and lock in your gains and, live to fight another day. So, so I think, so going forward, I think I'm a little bit less, thematic focused right now than I was in 2020. Even though I'm super bullish on EV, I'm out of Tesla because it just rallied so much. I mean, it got up to a $650 billion market cap. So, I loaded up. So I think it was, I forget exactly what date I think it was either late November or early December when they announced, or the S&P announced, that they were going to add Tesla to the S&P 500. And I'd already done a ton of research and I tweeted about it, what would happen to the stock once they get added, how much buying would have to happen by these indexes and then the front running by the hedge funds, and, the window dressing and, what the fund manager are doing, before year end, they want to show that they had Tesla in their portfolio. So, when that announcement came out, I mean, I was super bullish on Tesla. I sold the bottom 20 or 25% of my portfolio that night and then loaded up on Tesla at around, I think, 440. But, as it rallied in the following 3 or 4 weeks and it got up to 695 on the day of the S&P edition, that's where I sold a ton of my stock. And then over the next few days, I got out of the rest of it because I just don't see. I mean, I think some of the stocks in my portfolio can rally 30, 40, 50% over the next 12 months. I don't think Tesla can do that. So I don't think, even though I'm super bullish on EV and I do own NIO still, mostly because of the technicals, it pulled back and now I feel more comfortable getting into it. And I would love to get back into Tesla, but it would have to pull back 15, 20% for me to get back in. And then same thing with e-commerce, right? I mean, I was super bullish on e-commerce in 2020 and it did what it was supposed to do. All these stocks ran up 300, 400%. But I mean, I'm out of Amazon. I'm out of Shopify. I'm out of Farfetch. I'm out of Etsy. Phenomenal companies, but I just don't know how much left they can run, especially if we get a big rotation into value again, or we get a big pullback in the broad markets or tech, multiples contract. I mean, there's a million reasons why these stocks back in, but I see too many other opportunities in too many other industries for me to ignore and then just keep banking on the stocks that have been working.
Absolutely. And you mentioned a term that I'm not sure everybody will know, window dressing. Could you explain kind of what that is and if it actually happens, since obviously you manage money yourself?
Yeah. I mean, I never ran a mutual fund. I mean, so I don't think I ever really did window dressing. But when you get like the big funds, that are all competing for large amounts of capital and, they have to publish their performance and their holdings at the end of each quarter. Sometimes they want to show that they owned the winning stocks from that quarter. So even though that the person looking at that fund may have no idea when they actually bought that particular stock, they'll see the stock in the portfolio and they'll just think that much more highly of the manager that they know what stocks to own. So it's it's kind of scummy, but it definitely happens. I don't know if the hedge funds do it. I know the mutual funds do it. I just don't know to what extent. So it's definitely out there, but I don't know if it's enough to really move stocks, in the last few days of the quarter or not. It's just a term that we always used to throw around when I was in the business.
Gotcha. All right. So let's talk about stock selection now, because I'm curious as an investor, how you go ahead and do your due diligence. So could you show us kind of, or actually just outline the general process of how you find out an idea, put in the research, put in that due diligence, and then finally end up executing and placing a buy order?
Yep. So there's a few places I get my stock ideas. One is absolutely FinTwit, right? On Twitter, there's a lot of people that are always talking about stocks, and that is a good place to find some ideas if you're looking for them. The other place is probably Screeners. So the one screener that I use the most often, I don't love it. It's good enough, at least for now, until someone creates a better one or I find a better one. I think, like you said earlier in our pre-show warm-up, Market Smith might have one that I like, so I'll definitely check that one out too. But I've been using Atom Finance recently. So I'm typically looking for stocks that are growing at least 40% a year. Market caps, that depends. But I mean, recently I've been looking for stocks with market caps under 10 billion and at least 30 or 40% growth. Usually I start with 40% growth and just see what stocks come through the screener. So I usually start something, that broad, 40% growth this year. Well, at least, 2020, right? I mean, now that I'm doing the screeners, I still do care. So if I was doing a screener tonight, I would probably still use 2020, but I would also use 2021, 40% growth both years, market cap between, let's say 250 million and 10 billion, and then just see what comes through. And it, might be 30 stocks, 40 stocks, 50 stocks. Most of them I'm pretty familiar with because I've already seen them in, the stock screens every single week for the past 6 months. But every once in a while, there's a new name in there that I'm not familiar with. And then if I don't see any new names in there, sometimes I'll drop it down to 35% growth or 30% growth until I actually start to see some fresh names. And then I just have to go through and, pick the ones that I think are the most interesting. If it's biotech, I just ignore it, pharmaceutical, therapeutics, genomics, all of those. I just don't understand. Even, semiconductors and a lot of these other like really technical industries, I'll never understand them enough to feel comfortable buying a stock in that industry. So I just stay away from them. I don't know if I think I've owned NVIDIA, but I've never owned a semiconductor other than that. So I need to be able to understand the industry for me to buy a stock. But so the stock screens, and then so in terms of so other place I get ideas. So newsletters. I mean, I probably subscribe to 40, 50, 60 different newsletters. Some are from the big firms, Morningstar, Barron's, those types of companies, and then others are just like the Substack letters that people on Twitter put together and they'll write about different stocks. Those are probably the three places. It's probably the, newsletters or research articles, screeners, and then FinTwit. Like it's definitely not CNBC and Bloomberg. Very rarely are you going to get a stock idea off of the TV. So if that's where you're looking for your ideas, you're probably in the wrong place. And then in terms of like research, so I don't look at the charts yet. I mean, I do go to the fundamentals right away. So that's when I'll typically pull up, ticker. So TIKR.com is typically where I go to. I believe they get their data from Capital IQ, which is also Standard & Poor's. So, they're going to show you the consensus estimates. So I think, so they just show you the consensus estimate, but then I also look at Yahoo Finance because they'll show you the spread. They'll show you the consensus, but then they'll also show you the lowest estimate and the highest estimate. So you can kind of get a better feel for that spread between, the analysts and, the most bearish versus the most bullish. So those are the two that I typically look at for fundamentals. And then I'll start to dig into the company, assuming they've been public for a while. You're going to have some analyst research reports that you can go through. You go to the website, the company's website, investor relations link all the way at the bottom. And there you're going to get, transcripts or, recordings of conference calls. You're typically going to get some sort of an investor presentation. You can obviously look at the management team and the board and all of that. get to understand the company, learn about the products. And then from there, I'll dig into the fundamentals more, look at the numbers. I do have a spreadsheet, and I've talked about this before on Twitter. My valuation model, which is 100 variables right now. So assuming that the company is large enough where the ticker and Yahoo Finance, well, mostly ticker, is going to have all of those data points, then I can, add that stock to my model and just see what model comes out with for a 12-month price target. So that's that's part of my research process. I mean, when I do, and it depends. I mean, on some companies, if I just want to start a starter position, if I look at the charts and the stock's already had a really big run, it's very unlikely that I'm going to start a big position in that company right away. I might start a smaller position, which is maybe 1 or 2%, and then see if it pulls back for me. If it's already had a recent pullback and I get really bullish, then I'm likely to start with a bigger position, maybe 3 or 4%, although 4% would be pretty large to start with. And then, sometimes if it's a stock that I'm interested in, but it's just really outside of my area of expertise, or it's like really complicated, but I think what they're doing is really cool, I might just start, what I call like a moonshot position, which is typically like 0.5%. And if it's a stock that I've started to do a little bit of research on and it looks like it could move pretty fast before I get a chance to really dig into it, I'll start a smaller position just so that it's on my screen and I can watch it trade for a few days, because there's just too many times where I'm like, oh, that stock looks really, really cool. I'll put it on my watch list, and you just kind of forget about it. It gets buried into all the other stocks in your watch list. And then you look at it 3 days later and it's up 15 or 20%. So, if it's one of those stocks that I just think it's cool and it might be a stock that I want to, add to later, better just to start with something small, get it on my screen. So at least, sometimes it's only 5, 10, 15 shares. I mean, just to have it on my screen so I can watch it trade throughout the day and then start to set up my limit orders as I do more due diligence on it. But I mean, for me to build a core position, I'm typically doing at least 8 to 10 hours of due diligence and research. When I do my Substack newsletters, if I'm doing 2 per week, each newsletter is for one stock. I mean, that's at least 8 to 10 hours, sometimes more than that, when you start to calculate all the time spent on writing and proofreading and whatnot. So, I mean, it's a lot of work. Just reading an S1 a couple times, I mean, that could be a couple hours by itself.
Very cool. And would you mind bringing up just ticker and just give us an example of kind of top criteria that you look for on that platform? So if you could just share your screen
and do that. Screen first.
And you can bring up, I guess, any stock, maybe one you're looking at right now.
Yep. So I was just looking at, you can see my screen, right?
Yep.
Yeah. So I was looking at Billy today because a bunch of people on Twitter were talking about it. And I guess let me see. Oh, so I think ticker, so the price over here is actually the price from last night's close, I believe. So I think they only update their price once a day. But I believe the stock was still up 13 or 14% today. So it's kind of, I never heard of it before. So someone on Twitter explained it to me. It's kind of like the YouTube plus Reddit plus Twitch of China. Now, I'm not sure why the stock moved 13 or 14% today, but that's the one I was looking at last. So let's just say, we can use C since everyone probably knows this stock. So, the 2 numbers that I look at first, right? Well, the 3. So market cap and enterprise value. And then on estimates. So I'm typically looking, the first 2 I look at are revenue growth. Just make sure it's in US dollars. Yeah. Revenue growth and gross margins. So in my opinion, those are the 2 most important things to look at when you're investing in growth stocks. A lot of these companies, if they're growing 40, 50, 60, 100%, most of them, when they're still in that hyper growth mode, they're going to be losing money. So, I guess if they're still losing money, you at least want to see the number going in the right direction. At least they're getting closer to profitability. Obviously having better growth, if the gross margins are improving, that's one way to get to profitability. EBITDA margins, net income margins. Let's look at one. That's closer to profitability. So, I'll talk about Futu. So Futu is one of my biggest holdings. I've been in this stock now for, I think, 3 or 4 weeks. I believe it IPO'd this past summer. So I think it's been public for about 6 or 7 months now, rallied up into the low 50s, started to pull back. I added it in, I think, the mid 40s on the way down, hoping it would bounce off the 20-day moving average. And it didn't. It fell all the way, broke through the 20 and then found some support in the last couple of days near the 50. But the fundamentals on this one are just phenomenal, right? The growth this year, 171%. Next year, I've talked. Oh, I can put this in US dollars. So ticker says 31% on 486 million of revenue. If you look at Yahoo Finance, their estimates are, I believe, over 500, and the high out there is, I believe, 600. So I'm not sure why the consensus estimates on ticker are so much more conservative than the ones on Yahoo Finance. So it's kind of hard to, it's hard to know who to believe at that point. But clearly, guys like me don't know these companies well enough really to, determine what that right number is. Is it 500? Is it 550? Is it 600? So, in a case like this where there's some discrepancy between ticker and Yahoo Finance, I'll typically use a number in the middle somewhere. So, 45, 50% growth this year for Futu, but then you look at the gross margins, 75%. They're very profitable. EBITDA margins, net income margins, incredibly strong, huge growth. So, there's a lot of reasons to love this stock. Futu's kind of like the Robin Hood or the Webull of China, based in Hong Kong. So, not only is the story interesting, but the fundamentals back it up, and then now the technicals support it as well. So, that's why I'm so bullish on this company for the next 6 to 12 months. Everything's kind of lining up properly right now.
Absolutely. And Jonah, let me ask you this: for each of these kind of main fundamental criteria, what is like a base level that you look for? So is it like over 50% revenue growth, gross margins? What are you looking for? Could you talk about that?
Yeah. So I pulled up yesterday. I just created a spreadsheet for myself of all the stocks that I currently own and the estimates for this year, for 2021, just to see how they all compared against each other. And because I wanted to see if I owned any stock. So not that I sold Etsy for this reason. So the estimates for Etsy for 2021 were only like 12 or 13% revenue growth. And even though I think they're going to beat that handily, I'm not sure they're going to get up to 30 or 40%, which is where I really want to be. So, not that 30% is my absolute bottom minimum, but I don't think I own any stocks right now where revenue growth for 2021 is expected to be under 30%. And so, if I'm just going through them right now, so Celsius looking for 53% revenue growth in 2021, CrowdStrike 50%, DraftKings 54%, Docusign. So Docusign is probably the lowest one that's left at about 38%. Although I think that might even be a little bit conservative. So, I think some people call Docusign a pandemic winner, a COVID winner. I think out of a lot of the stocks that did benefit, let's say Pelotons and maybe Etsy's and Zoom's, I think Zoom's going to be pretty sticky revenue. Well, I shouldn't say that. I think some of Zoom's revenues will be sticky. I think all of Docusign's revenues will be sticky because anyone that started to use Docusign during the pandemic, I don't think they're about to go back to the old way of, mailing out documents to people, having them sign it and mailing it back. Like that is so archaic now since Docusign's available. So any revenues that Docusign's pulled forward, I don't see them losing any of those revenues. Whereas, I think once the gyms open, I think people will start to, be less excited about jumping on their Peloton every day, right? They'd rather go to the gym and actually see people and socialize. At least that's me personally. And even e-commerce. Not that I expect the malls and retail stores to flourish, but I do think that some people will go back to, shopping in brick and mortar stores because it is actually nice to be able to try on clothes before you buy them. So, even though I still like e-commerce long term, I'm just not as bullish going forward as I think other people are, and I think the valuations have gotten stretched.
Mm-hmm.
Fastly, the estimates for this year are a little bit more conservative than my own estimate. So I think the analysts are looking for maybe 35% revenue growth. I'm closer to like 40 or 45%. I still got my fingers crossed that TikTok maybe comes back. Futu 50%, Fiverr 46, Grow Generation 62. So one of my positions that I'm super excited about that I don't think most people have ever heard of is Make Your Trip or Make My Trip.
Mm-hmm.
So it's like the Expedia of India.
Mm-hmm.
And they got hammered this year, obviously, with the pandemic and no one able to travel over there. But growth is going to explode this year. They have huge gross margins, about 80%. So I think that's one for people to keep an eye on. It's only a $2.5 billion company, and they'll do probably 500 million in revenue this year. So, what's that? Maybe 6 times sales, because it was up 5% today. So let's say
Mm-hmm.
6 times sales with, this year it's like 180% revenue growth and 80% margins. That's an interesting business for people to keep an eye on. Mohawk, which is a company that was in my newsletter last week, they should grow
Mm-hmm.
at least 60-65% this year. Cloudflare, Pinterest. So all those, all my companies that are in my portfolio right now should grow or expected to grow at least 40% this year. The average, if I averaged it out, actually, I can do that right on the fly.
What's the symbol for Make My Trip, by the way?
MMYT.
MMYT. Gotcha.
Yep.
And MYK is the other one, right?
MWK is Mohawk.
MWK, right.
Yep. So I think so. Fetch, Farfetch, and Etsy are still in here. Etsy is going to drag this number down a little bit, but oh well. So the average revenue growth for the stocks in my portfolio, based on the consensus estimates for 2021, is 56.8%.
Not bad.
If they could hit it. But obviously, if they don't hit it, the stocks get cremated because they're already selling at lofty multiples. So,
Mm-hmm.
that's the risk that we're taking this year in 2021 is if you get any multiple contraction, and this is, a lot of the current valuations, the prices some of these stocks are at right now, this growth is already priced in. Fastly, like I've loved Fastly this year. I've made a lot of money, and then I also got burned a couple times. But overall, I'm still positive on the position. But I don't know, at a $10.5 billion market cap, and maybe $400 million in revenue this year,
Mm-hmm.
that's expensive. If they don't do at least 40% growth this year, that stock is overpriced. So,
Mm-hmm.
The expectations on some of these companies are really high. And I'm just not sure if all these companies are going to be able to hit those numbers. Although I will say in Fastly, yes, they benefited from the pandemic because a lot of their biggest customers are Shopify, Pinterest, Etsy. So as people were spending more time online, they were obviously using Fastly right behind the scenes. But a lot of Fastly's other biggest customers are the travel companies. So Airbnb, JetBlue, I'm trying to think who else is in there. Hotel Tonight, which is now owned by Airbnb, I believe. So as the travel industry comes back, or as the economy bounces back, I think Fastly will win that way as well. So I don't think, Fastly isn't just a COVID winner.
Absolutely. Would you mind bringing up just TrendSpider real quick? Because I want to ask you about how you decide to actually enter a position, whether you're using moving averages, and also it'd be great to talk about how you decide to trim positions right here as well.
Yeah. So as you can see, so Celsius is actually up on my screen right now. So I was looking at that one earlier today. So I actually did trim some Celsius today. And the reason is because it started to poke through this Bollinger Band. So you can see, the 3 Bollinger Bands that I have, so I use it, so that off of the 20-day moving average, and then it's 2 standard deviations, 2.5 and 3, both plus and minus off of the 20-day moving average. So typically, not all the time, it's not like a strict policy, but more often than not, once the stock starts to poke through the Bollinger Band, I'm going to at least consider trimming it. Maybe it's a 3 or 4% trim, maybe it's 5 to 10. And then as it, climbs and hits, keeps poking through more and more levels of the Bollinger Bands, it's probably going to keep on getting trimmed because, you can see right here where, it got up, so typically when you see it start to get through that second and third Bollinger Band, a day, 2, 3 days later, you get that pullback, and, right over here, big pullback. So I feel like the Bollinger Bands, at least for me personally, are a good indicator of when it's time to start trimming a position.
Mm-hmm. For me, I actually noticed that, yes, they can get extended above that Bollinger Band, but I actually like buying and owning stocks that kind of are always near the top of that because that shows they're under accumulation. There's a lot of power behind that move. I mean, even that gap up, that was just kind of the start of this strong move from 35 to 45. So
right.
I like seeing the stocks up there, but obviously you're right. They can get overextended and go too fast, too quickly.
So I didn't trim any Celsius here. So sometimes I do wait until it gets to the 2.5. Mm-hmm. And so today was actually, I'm trying to think, did I trim? I might have trimmed a little bit of Celsius last week, but I wasn't trimming it right in here. Another stock I trimmed today was Fiverr, and I trimmed it before. So to be honest, it's not even anywhere near the Bollinger Bands, but after looking at my spreadsheet and just where the stock has come from over the last year and just wondering what might be left or not left in the tank for this one, I just felt like, I don't see 30, 40% this year, at least from these levels. So, and some of my other stocks, I believe, can do that. So, this was let's see, Fiverr is, so after the trim today, Fiverr is about a 3.8% position. So, I guess I wouldn't call that core anymore. But I mean, it's not like I didn't dump it out of my portfolio because I still like it. But I just think, I think I trimmed it around 205 or 206. It's one of these stocks that if it pulled back 10% at the beginning of the year, I wouldn't be surprised. So I'm just trying to play a little risk management here.
Absolutely. And let me ask you this. So I've often noticed that you like to trim stocks pre-market, maybe when we have a gap up. Could you explain kind of your methodology, how you decide which stocks to trim? Are you doing them all at once? And how you decide to trim and also add back on maybe once they drop closer to that 20-day moving average?
Right. So, I mean, some stocks, it's a good point. I mean, I think it was Monday, I think it was up 2 or 3% pre-market and thought it was going to be a pretty good day. And then the market opened and boom, it was just like we fell off a cliff. So, obviously I didn't see that coming, but I did do a little bit of trimming pre-market. So sometimes it's just kind of, my instinct or a gut feeling. And, sometimes it's better to be lucky than smart. So, and I think more often than not, it's just kind of luck where, you just feel like some of your positions are maybe a little bit too frothy, especially after last week. I mean, I think coming into this week, I think I was up 45 or 50% on the month. And then I got hammered on Monday and Tuesday. Now I'm up like 30 or 35% for the month, which is still good. But, you look back and you're like, last week is just, everyone was so enthusiastic. Everyone on Twitter was like, this is so easy. All my stocks are up 5% every day. I'm at all, I should have been more aggressive in my trimming just based on that, that enthusiasm, that, euphoria. But, you can't always just base it on what people on Twitter are saying. That's a hard way to run money. So I mean, I didn't do any trimming today pre-market because, I got hammered the last couple of days. So it's not like I felt like any of my positions were, getting ahead of itself. But, as I was up 4.5% today. So that's when I started to do a little bit of trimming just towards the end of the day. Like I said, trimmed a little bit of Fiverr, trimmed a little bit of Celsius, trimmed a little bit of my Grow Generation, trimmed a little bit of my Neo. That was pretty much it.
Jonah, how much are you trimming when do you decide to take some off?
Let's see. I mean, today it was pretty minor trimming. So I trimmed Grow a couple times altogether, maybe 4% of my position on Grow. Fiverr probably, let's see, rather than try to do math. Fiverr was a little bit more aggressive. So it was about 12% of my Fiverr I trimmed today at like 205. Where did I trim it?
And do you have a plan going into the week? Like if the stock gets up to this level, I'll take some off, or are you just kind of doing it day by day and seeing where it goes from there?
Yeah, it's more day to day. I mean, it's funny how many times, I should probably stop doing this, but you wake up in the morning, you see the market, you're up, 2-3% pre-market. You're like, okay, I'm going to do a little bit of trimming today, and you start to set your sell orders for the day. Like, okay, I'm going to trim Docusign at 250. I'm going to trim, Roku at 360. And then the market starts to rally and you're like, oh shit, I don't want to trim too early. Right. So you cancel your sell orders. Then all of a sudden the stock drops. You're like, oh my God, why didn't I trim it? I'm an idiot. So I feel like more often than not, I'll set those sell orders. And 80-90% of the time, if I canceled them, I regret it pretty quickly. So I think in 2020, because 2021, I think it's going to be a choppier year. I think the active managers will be able to add a lot of alpha compared to the buy and sell guys, assuming that they're good at what they do. I think we're going to get a lot of these, rips and dips as we get, economic data and, COVID data and vaccine data, all the stuff that's going to come in the next 6 months, tax rates, blah, blah, blah. I think there's good, so I think I'm going to be a little bit quicker with the trigger in 2021 and, look to trim when things, so maybe instead of waiting until something gets up to the 2.5, Bollinger Band, I trim it when it gets to the 2 and really, take your gains when you can before they're gone.
Gotcha. And would you mind talking through a chart of maybe a stock that you just bought and explaining what you look for in terms of an entry setup and also how you kind of add more as it drops? Maybe I think you mentioned you use limit orders. So if you could explain that process, that would be great.
Yeah. So I think I know we talked about Futu. So I've been in Futu since right about, let's see, I think it was right in like the mid 40s. I started buying it, wrote it down to the 20, got a little bounce. I got all excited thinking that I had timed it perfectly. And then we broke through and, got a couple of these fake breakouts and then boom, came back down to the 50. So, when we got around here, 40, I started really adding to my position over the last week. I was buying a lot of Futu. I was trimming some of my other positions just to add to this one. And coming into yesterday, Futu was actually the biggest position in my portfolio. And then yesterday on the big pullback in Square, C, Crowd, I added to those positions. So now they're back to 1, 2, 3 again. But then we got the nice bounce off the 50. I'm trying to think. So what's another one I added recently? I added a couple small ones today. I'm almost scared to talk about them because I haven't done a lot of due diligence on them yet.
What about UPSD? I think I saw that was in your portfolio, right?
Yeah. So, that was my deep dive in my newsletter that I did a couple days ago. So I think when I added it, I think it ran up 10% as soon as my newsletter went out. So I was hoping that was the beginning of a nice little rally. So this one's going to be hard. This one's such a recent IPO. It's going to be hard to really get anything from a chart. But so this one, I did not buy this one based on any technicals, really. I bought this one exclusively based on the fundamentals, the story, just how important I think AI is going to be going forward in certain industries. So Upstart operates in the credit and lending industry. The team that started the company 8 years ago actually came out of Google. They have, world-class VC investors behind the company. They came public 3 weeks ago. I think it was the same week that Airbnb and DoorDash came public. So everyone was paying attention to those two. And Upstart kind of, came flying, under the radar. So I really hadn't seen anyone talking about this name at all. And then someone just happened to DM me and ask if I knew anything about it. So I looked into it. I'm like, wow, this is really interesting. So, typically the underwriting departments, whether it's a personal loan or a mortgage, they're using FICO scores, which has been around for 30 plus years. And it's just a very limited set of data that makes up your FICO score. versus, what an AI powered model can do, looking at hundreds of data points over many, many years. That takes into like, your geography, your cost of living, like all, down to like where you went to school, all kinds of stuff. So, and I just think that's the future of the credit and lending industry, where you can have a more efficient, faster, cheaper model, determining who gets approved for these loans rather than having, three bozos sit around a table for 8 hours, nope, yes, nope, yes. I mean, like I've seen underwriting departments when I used to work at a trust company, we had we were partly owned by a bank. So I became good friends with the guys in the commercial real estate department, and they literally met twice a week to decide whether or not they were going to approve these commercial real estate loans. Like that's insane versus Upstart. Upstart is powering. So they built like a consumer facing cloud application that banks can kind of, plug into, white label. So, the customer of the bank goes to the website, applies for a loan. They don't know that Upstart is, behind the scenes powering the whole thing because it's all branded with the bank's name. But within seconds, this AI model is running those 1,600 variables and approving you or not approving you. And I believe I'm just trying to remember a couple of days ago, but I believe it was 70% of people that apply for a loan don't even have to provide, any additional documentation. They don't have to get on a phone call with anybody. They're approved within minutes, and all the back testing data that they've done, as well as partnerships with the federal credit. I forget the the government agency that they work with, but they've proven that they can approve 173% more loans while decreasing the number of defaults. And
that's big.
It's huge, right? I mean, because that's just added revenue to the bank. And then over the last 8 or 9 months since the pandemic started, the loans approved using Upstart have a 5% missed payment versus the national average at 11%. So even in like the worst of times, they're able to, determine which people are really higher risk. And one of the founders explained it really well in an interview. He said, I almost want to bring it up so I don't misquote it, but what did he say? He said, hold on, let me just bring it up because it was really good. And like, as soon as I heard this, I'm like, oh God, these guys get it. Okay, let me just pull up Upstart. Give me 2 seconds.
Yeah, no problem.
I just want to find the quote. So it's 3 founders. 2 came from Google, and then 1 was a Thiel fellow. So Peter Thiel started like this fellowship and was basically like paying really smart kids to skip college and come work for it, try to start a company, and he would back them. So the 3rd founder was like 20 years old when he started Upstart with these other 2 guys.
Wow.
What did he say? Hold on. Can't believe I wrote all of this. Wow.
It's extensive.
Yes, it was. I don't think people realize how long it actually takes.
I'm sure they appreciate it.
I was actually hoping Upstart would reach out to me and be like, hey, great write-up. You nailed it. But no one, I actually did reach out to the IR department, and they're like, hey, we're in our quiet period. We can't even say anything to you. So I can't find it. I mean, I'm trying to like talk through and scroll through it. But he basically said that, if you take out a loan and you don't miss any payments and you pay off the loan, then your interest rate was too high, right? And if you do miss a payment or you don't finish paying off your loan, then your interest rate was either too low or you should not have been approved by for a loan in the first place. So I know it's not quite that simple, but like when you think about it in those terms, you realize how many people do pay, too much in interest rates. So I think it was 28%. So I believe that the people that get approved by them pay 28% less on an interest rate than other underwriting models that are out there. So not that I didn't know we were going to talk about Upstart that much, but yeah, I mean, this is the company that I'm really bullish on just based on what they're doing, the size of their industry, because they started with consumer loans. That's what they've been doing for the last 7 years. And now they're getting into auto loans. And then hopefully this year or next year, they'll get into mortgages and then credit cards, business loans. So, because I just think the whole credit lending industry is ready for a massive disruption. and it's possible these guys could be the ones to do it. Just like Lemonade is trying to do it for the insurance industry. Mm-hmm. So I'm also in. So it's funny, after I did all of this research and really got to understand the power of AI, I got super excited about Lemonade. So I jumped back into Lemonade, and it just so happened to be the day that the stock was down, 10, 11% because of the 6-month lockups. And now it's rallied, I think, 15% in the last 2 days. So that was more luck than anything else.
Absolutely. And if you go back to the chart on the technical side, this came up on my screens. I like to look at the IPOs because there's a lot of great growth here, and the numbers for this were fantastic. But I love how it rallied right from the start all the way up to 45, and now it's slowly tightening up a little bit on the right-hand side, and it still hasn't quite formed the IPO base, which is what we call the first primary base, but it looks promising. And if it does take out that kind of low at around 38.50 or so, it might need a little bit more time to shape up. But overall, I mean, this kind of has all the characteristics that I kind of look for. I'm not quite sure what the dollar volume on this just yet is, but it looks good from both a fundamental and also the technical side of things.
I know I'm mad at myself for not catching this one sooner. I think the IPO priced at 20, and I think it opened up around 26 and then ran up to 29.
That's a great sign. Yeah.
Yeah. And then now it's obvious, that was a great first day pop, but then you look at like what Airbnb and DoorDash did, up 70, 80, 90, 100%. And it's like, oh my God, some of the IPO numbers over the last couple of months have just been insane, which I think is why we're going to see more of these direct listings. And now that you can raise primary capital with the direct listing, that's going to be a good alternative for companies to go public and, not leave too much money on the table. So do you jump into companies before they get through the 6-month lockups?
Yes, I will. But I will never trade them the first few days. I have to wait for that first primary base to form. Just so many of these IPOs. And I'm actually interviewing Kathy Donnelly from the Lifecycle Trade. I don't know if you're familiar with that book, but they studied all these massive super stock IPOs and analyzed the perfect time to buy them. And you either want to wait for the IPO base or when it does that first longer term primary base, kind of what we saw CrowdStrike do this year, and buy it once it takes out that first high that it breaks, if that makes sense.
Yeah, because I remember Snowflake. I thought I would buy Snowflake if it came public at around 50 or 60 billion, but I think by the time it opened, it was 85 or 90, and around 240, 250, I think is where it opened. Ran up to 300 for a couple minutes, and then over the next week or two, it came all the way back down to about 215, 220. That's where it formed a base, I guess. That's where I should have gotten in. And then from there, it rallied up. I forget.
Bring it up.
Yeah. Whoa. Let me see if I can shrink this down. There you go.
Yeah, there you go.
How far back does it go? Was that September? Holy cow. Was it that long ago that Snowflake came public? Jeez, it feels like
maybe.
Wow, feels like it was more recent than that, but I guess that's only 3-4 months away. So, where did it? So it got up to so like the first day, that was just insane. Got up to like 318, 319, and then pulled all the way back down to 210, 211, somewhere down here. That's where I guess that's where I should have jumped in. Would you have known to jump in here?
That's definitely a more risky entry. I probably would wait on this stock until it takes out that first high that it set on that first day, or just before it on right near the 23rd of November would probably be where I'd be looking.
Gotcha. Okay. Yeah. So once it breaks above that previous high, that's when you look to get in, and then.
Yeah, that's what we would call the pivot price right there.
Okay.
If it breaks through that on volume, that's a good buy signal for these IPOs.
So do you use? I think I've seen you post about it. You use VWAP, right?
I don't. I'm trying to learn that. Ben Pattern Profits, he's been posting all these charts, getting me excited about it. Brian Shannon's been encouraging it, so I probably will add that to my arsenal, but not yet. But I know the anchored VWAP from the IPO price is definitely something that those guys use.
Right. Okay. And that probably would have helped someone on this one too. I've never really used it. And that's where, I don't invest on technicals alone. I have to believe in the story, the fundamentals, And I mean, when Snowflake came public, yeah, I think they were still growing at 130, 140%, but that was obviously going to slow down this year to, I think, 100%. And, looking, back when they came public, even in October, November, as I just kept looking at it as it pulled back, even looking at 2021 numbers, what the price to sales multiple was going to be, it just didn't make any sense to me. And that's why I'm not ready to jump back into Zoom yet, but I mean, I've been out of Zoom for the last 3 or 4 months because I figured at some point we have to look at 2021 numbers. We can't worry about how well they did this year. And, what are they going to do next year? I think the revenue estimates right now are somewhere around 3.6 billion. I mean, even if they blow that away and do 4 billion, I think the market cap is still somewhere around 110, 120. Actually, maybe it might be down at 100 now.
Yeah. Why don't you bring up the chart of Zoom if you got a second?
Yep.
Because for me, it looks like it's forming the left side of the base, maybe starting to bottom a little bit. But for my approach, it needs time to really make sure digest everybody who's selling at this point.
Right. So, I mean, I got into Zoom somewhere back here. No, actually, it was earlier than that.
Yeah, I traded it around there too. As it retook the 50-day, that's kind of my most recent big buys when I got into it.
So I first got into Zoom around, I think 110, and then rode it up to, I think, 220 and felt like a genius because I made, I was up 100%. And then, of course, sold it way too early as it rallied all the way up. And I think I jumped back in somewhere around 350, rode it up to 450, got out. So I've traded this one a few times as well.
Yeah.
But I worry about the current, even though it's pulled back, I think 35 or 40% from its highs. I still worry about what kind of digestion in terms of, the market cap, or at least the fundamentals catching up to the market cap. Does this thing go sideways for 3 to 6 months? Is there more downside? I mean, obviously it's below all the moving averages, right? Yeah.
Yep. And you see those big gap downs. For me, that's a sign that institutions are getting rid of some shares at least. I mean, I think it needs time to really form out a nice longer term base. But it's definitely one to keep an eye on because they're a disruptive technology, great growth numbers. And if they introduce some more products, I mean, that could fuel so much future growth. I mean, everybody has a Zoom account right now. I mean, we're recording this podcast on Zoom right now. So it's everywhere. It's ubiquitous. And I'm definitely going to keep an eye on this. And if it starts recovering all those key moving averages, I'll look for a nice low risk entry where I can get out quickly if it turns against me.
So if I throw in the 100-day moving average, okay, it's below that.
Yeah.
I don't think I even have the 200 as an option because I don't think any stocks that I'm looking at right now are even close to their 200-day moving average. So, I mean, with Zoom, so, if they do 4 billion this year, in 2021, $100 billion market cap right now. So it's trading at 25 times sales. So normally, like the very first test that I use just for the fundamentals for growth companies is I want to see the current price to sales multiple at 50% or lower than the growth rate. So if the current price to sales multiple is 25, then I want Zoom to show me 50% growth. I want to be able to look at the estimates, the consensus estimates, and see 50% growth or more next year. Now, and this is all in my model. I mean, it does depend on the gross margins, the operating margins. Zoom has very, very strong margins. When they came public, one of the reasons that they got such a lofty price to sales multiple that very first day of trading is because they were already public. I mean, they were already profitable versus all these other, SaaS companies or cloud companies coming public that were, losing huge amounts of money still. So, I mean, Zoom already, are always been in that, that profitable camp, which I think means they can get added to the S&P 500 pretty soon. Because I think they've been public now for at least 4 quarters, and I believe they've been profitable every quarter. So, I mean, we could get that announcement probably anytime. I'm assuming they're not going to, they're obviously not going to do it this year. And I mean, I think these indexes are probably still digesting Tesla.
Yeah.
So maybe they wait another quarter or two, but I would assume sometime in 2021, we'll see Zoom get added to the S&P 500. I think Shopify will be eligible, although because they're a Canadian-based company, I'm not sure they're allowed to go in.
Mm-hmm.
So, but that'd be interesting one to watch too. But yeah, I mean, so this is what I'm trying. This is what I've been doing the last couple of months, is trying to figure out, of all the stocks I own, which ones can keep putting up big numbers, which ones have these massive runs, and even though the price to sales multiples still look reasonable. Like I have to try to put myself in like the shoes of these big fund managers, and like what's their thinking, what's like the sentiment out there, and how many of them want to keep owning these COVID winners versus rotating into these other the other sectors and industries that might benefit more from an economic rebound, from more stimulus, from a big infrastructure bill, that sort of thing.
Mm-hmm. And I own CrowdStrike, and I think you do too as well. Yep. And I mean, that could be considered a COVID play, but I think it's a little bit more than that, because I mean, cybersecurity is going to get more and more important. I mean, we've seen in the news recently all this stuff that's come out about this. I mean, and this company is disruptive, growing at an incredibly fast rate using AI. And yeah, this is a very promising holding, even though it's short-term extended here, definitely. I still have a half position, so I'll look to add off the 21 EMA, or if it pulls back even more, at another good low risk entry. But this is an example of something that's considered a COVID play, but I think has a longer time horizon. I think it's gonna be a very, very good winner.
Yep, me too. So the last couple of days, Monday and Tuesday, when I got hammered in the market, I did make some moves. I mean, that's when I sold my Peloton, that's when I sold my Etsy. And then I added it to CrowdStrike, added to C Limited, added to Square, because I think these companies are not just COVID winners. I think these companies will keep that revenue going. And like you said, I mean, we're living in a world now where, we're all spending more time on our phones and our laptops and work from home, and cybersecurity, the need for cybersecurity is not going away anytime soon. So Now I would love to find a smaller version of CrowdStrike, but it seems like all the other cybersecurity companies that I look at that are smaller have half the growth rate of CrowdStrike. So it's like, even though CrowdStrike is a $45 billion company, they're still growing faster than everybody else in there, because they're just that much better. So, because not that I don't want to own any large cap companies anymore, but I just feel myself kind of getting pulled towards those smaller cap companies if they're growing faster than the larger cap companies. But if the, like Shopify, right? I mean, big commerce is, a fraction of the market cap of Shopify, but Shopify is growing 3 times faster. So if I get back into that, that e-commerce SaaS space, I would rather own Shopify than big commerce for that reason. So.
And you can kind of see that in the charts. I mean, if you pull up Shopify versus Big C, you can see which company the big institutions are going for here. I mean, Shopify already had a crazy run, a nice long-term base, and now it's just starting to show some movement once again.
Yep. So this one was frustrating. I mean, I forget. I mean, I've been in and out of this name a few times this year. And all these times where I was adding here, and then you'd start to see this breakout, and you think you're going up to 1,300, 1,400, and then you get that nasty pullback under 900. So I mean, this happened a few times, right? I mean, this was a very frustrating sideways pattern. So I finally sold it right around 1,200 the other day, because I didn't want to get screwed on another pullback and watch that position, watch my gains disappear again. So I'm actually hoping this one comes back and tests the 20-day. I'd probably get back in, because I do still love this name going forward. I think that, the 4 ways to win, right? I mean, they have the monthly fees they charge their customers, the payment fees or the transaction fees, the app store, and then now they're getting into, fulfillment and logistics. So, I mean, I think this company's gonna be a beast for the next decade or so, but I don't want to chase it. It feels like it still has to kind of digest that $140 billion valuation.
Yeah, how I see it is I wouldn't have really been looking to trade it until, if you draw a line from the 31st of August, that high.
August 31st, where's that?
So up, if you go up a little bit.
Oh, yeah. Like,
from the high of that bar, and just draw it across. Yeah, anyway, I would have been looking for a breakout of this line, maybe draw a downward trend line. or that earlier
I
consolidation
I don't draw a
that then
lot
breaks out.
I don't draw a lot of lines, as you can
Yeah.
tell.
Yeah.
But I don't know what's, okay.
Yeah. But for a swing trader or position trader, I do not want to be chopped up in the space. I want to make sure it's making a longer term move before I try looking for a position. And
So
this to me just looks like it's pulling back to the pivot beautifully. And I'll probably look for an entry on this stock actually.
would you wait for it to find support on the 20-day?
Well, it's very close to the 20-day and also the high of this base, which is that high point at around the 31st of
Right.
August. So
Okay.
this would be a pretty good spot to start building a position, and maybe it undercuts that pivot level and retakes it on a high volume. That would be a buy, or if it just kind of continues move up from here, because that moving average is just kind of an area of interest for me. It doesn't have to fall right to that moving average.
Right.
It's just kind of a guideline of the trend. So yeah, I'll be watching this closely next week into the new year.
Now, do you look at the fundamentals as well? I mean, do you care what Shopify's revenue growth or margins are for 2021?
Yeah, I do. I'm mostly concerned with the earnings estimates for 2021,
Okay.
and I want to see those to be the higher the better. Over 100% ideal. I mean, GRWG, Peloton, those are all over 100% earnings according to MarketSmith. So that's great. I also look at the most recent quarter, how it did in terms of earnings and sales growth and all of that. And Shopify, I mean, has great numbers overall, and it's a great story, like you said.
What's one stock that you've added recently?
Well, today
I can pull it up.
Yeah, so today I added to let's see. Well, I started back my position in AMD actually.
Okay.
Bring that up.
That's been a nice winner, kicking Intel's ass.
Yep. And I actually also bought Neo, so we can talk about that after this one. So recently, if you zoom in a little bit to the recent action, it moved up from this nice double bottom base, and I built up a position and then sold as it undercut some levels up recently. But I put my position back on as it had a nice reversal yesterday, and then a nice move above that high today, and then I can enter today with a stop loss below yesterday's low with a very good small stop. So that's
Gotcha.
kind of so my stop is right below that low. If I get stopped out, it's a small loss. If it keeps going, that's fine. By the way, do you use stop losses at all on your positions?
Yeah, I do sometimes. I mean, typically, like you said, on a new position where, especially if it is kind of hugging the Bollinger Band on the way up, and I'm afraid it might break down, I'll use a stop loss to protect myself. But I'm not big on them, and I'm definitely not big on them on core positions where if it pulls back, I'm just most likely to add to it anyways, because I mean, sometimes these stocks can just reverse so quickly. And even like after hours, I mean, it's happened to me before where you'll use a stop loss and the company will report earnings and you get that quick drop within a couple seconds, your stop loss gets triggered. And then within 15 minutes, it's trading 10% higher. So I feel like more often than not, the stop losses hurt me more than help me. So I watch my stocks so closely all day long as it is. And even though I have more positions than you, I just don't feel like I typically need a stop loss. So.
Gotcha. Go ahead and bring up Neo.
Yeah.
This is another one that I bought just today.
This was a new name for me a couple days ago.
Yeah. So I love the reversal action yesterday off the 50-day moving average. That would have been the ideal setup. I wasn't watching it close enough, but today, as it took out the prior day's high as well as the day before's high, that was kind of the pivot point for me. So I put on a position, and I'll add if it takes out that kind of swing high at about just below 50. So the 21st of December, it forms that kind of swing high, pulls back to the 50, and I'll add through that point.
Gotcha. So where would you put a stop loss on?
Yeah. So today I put a stop below the 21 EMA and today's low.
Okay.
Yeah.
Right. Okay.
Yeah. Up around there. Yeah.
So
I forget
right
that.
Here, like 45. Yeah. So, okay. 45 area. Yeah. I mean, so my cost basis on Neo right now is, where's Neo? So 47.05. So yeah. So I started buying it. I think I started buying it right around here. thinking that, it would continue this way. And obviously we got a little bit of a reversal. So, I mean, I was just kind of adding this whole way down. But hopefully now we get the breakout to new highs that I've been hoping for. So I'm trying to think, I think the all-time high on this is, 56. So is this the all-time high right here? Yeah. Okay. So November 24th. Okay.
Yeah. I'm trying to buy as close to that kind of reversal point as possible off these swing lows.
Now, do you stick with any particular sectors?
I'm looking for how I find stocks. I'm looking for earnings growth, sales growth, primarily earnings estimates. And then and usually those are tech companies. So that's kind of what I'm focused on. And NEO is a name I've traded a lot this year. It's been pretty easy to trade, breaks out very nicely on high volume. Hopefully it does so again. But I mean, EV is a very strong theme. This has come quite a ways. So it might be a little bit more obvious. The general public might need a longer digestion period, kind of what we're seeing with Zoom here. But I mean, overall, it's setting up nicely. It's doing nothing wrong. Great reversal action off the 50-day, kind of textbook support there. And yeah, hopefully it breaks out above that kind of level around 48.50.
And this is what scares me, because I pull up my portfolio and one of the columns is year-to-date change. And I can put it in order. I mean, NEO is up 1,100% this year, right? I mean, this was like a $2 stock back in March, I think, $2 or $3. I mean, Celsius now is up 900% year to date. Grow Generation is up 900% year to date. So, like, it's just common sense to be like, okay, that, it's overvalued. I mean, if a stock goes up 900% but the revenues haven't gone up 900%, like, there's a disconnect there, right? You obviously got a lot of multiple contraction, or, you got pull forward or whatever it might be. But then, like, I look at the current valuation, I do think Celsius is getting a little frothy here, but if I look at Grow Generation, I mean, it's a little over 2 billion market cap. They should do over $300 million a year in sales. So it's under 7 times sales with a 60% growth rate. Like, that's not unreasonable. That doesn't, it doesn't strike me as being really frothy or overvalued right now. So I try not to pay too much attention to that year-to-date change, especially because this was such a, 2020 was just bananas. With the pandemic and all the stimulus and zero interest rates. Like, this was not a normal year.
Absolutely. And kind of what I go by is winners usually keep winning. Obviously that ends at a point, but I'd rather be invested in these stocks that are their industries are booming. They're benefiting from the current situations. This theme is going to continue, whether it's solar, electric vehicles, cybersecurity. It's going to continue for the next decade or so. And these are the leaders in the field at this point, and they're well positioned to benefit. And that's kind of why they're trading this way and under such strong accumulation.
Right. I mean, one of the screens I will never do is the 52-week low list, right? I mean,
Absolutely.
I'm not going out there trying to pick the bottom in broken companies or broken industries. I mean, that's, I guess that's what the value managers are doing, trying to find those turnaround stories. That's not what I'm doing. I mean, not that I'm looking for the stocks at the 52-week highs, but I'm more likely to buy stocks that are closer to the highs than the lows.
Absolutely. Could you bring up Fastly for just a second? Because I think this is a good, this
one hurts.
Yeah, same here. So I've traded this a couple times, gotten screwed a couple times, but I think this last gap down is a good example of.
I'm going to turn off the Bollinger Bands because they're just getting in the way.
Yeah, no problem. But I think it's a good example of kind of my mentality as a swing position trader versus maybe an investor. So I started building a position near the 50-day, and as it moved up, and it was going up like 35% in a week before this most recent gap down. And then obviously we had the gap down with the news with regards to TikTok, and I cut it pretty much right at the open. I watched a little bit to see how it would react, but I cut it pretty much right there. While an investor might sit through that drawdown, but also kind of waste a little bit of time there because they could invest that capital into maybe a different stock that would go up. So yeah, what do you kind of think about when you have a huge gap down like that as an investor?
I mean, that was painful. So, I mean, right, when they talk about catching a falling knife, I mean, this is like exhibit A. So, I mean, I first got into Fastly way back in the early springtime. You know, I took a small position, 2 or 3%, probably back in April. I might have even gotten it in March, I forget. And, you know, when it was in like the 30s, I think, you know, and you know, as I became more comfortable with it, you know, who their customers were, you know, believe that they'd be a huge pandemic winner, COVID winner. You know, I was adding to the position, you know, the whole way up, you know, looking good, feeling good. And then we got this sell-off where, you know, we first got that, you know, the Trump administration saying that TikTok would be banned if they didn't meet certain, you know, requirements. And I mean, I was reckless back then, and I said, oh, that's stupid. They're not going to ban TikTok. They'll figure this thing out. And I loaded up on TikTok, and it became like a 40, 50, 60% position in my portfolio for a couple of days, maybe even a couple of weeks. You know, rode this thing up to almost back to 100. And then that's when I started trimming it down and then added it back, you know, built that position back up again in September, rode it all the way up. And I think when it sold off here, I think the position was down to about 10 or 11% maybe. So that drop, you know, it did hurt. I think I might have added a little bit after hours. And then I laid off for a couple of days. I think I trimmed it. And then around here, I started adding it back in again. But I mean, I think even with all of this, I think I still made money on Fastly this year, but that drop hurt. I mean, that was the only month this year that I don't think I posted my performance numbers for the month because they were so ugly from that one drop. So I mean, I think that was a lesson to me that, you know, keep positioned under 10%. Or, you know, clearly this is when a stop loss would have helped me.
Well, not so much on the gap down. You can't do much about the gap down.
Right. Yeah. I mean, that thing's going to open the next day. God, I mean, so I feel bad. And this is, I mean, there's no way for me to control this or prevent it. But, you know, this is the world we live in now with FinTwit and people trying to be transparent. You know, when I post my portfolio and someone saw that my largest position was Fastly, you know, some of them might interpret that incorrectly and think, oh, Jonah still loves Fastly. Jonah's adding to Fastly up here, where I hadn't added to Fastly, you know, since like around here. I was trimming the whole way up. But other people, you know, they just follow each other into trades. They see, you know, so-and-so loves this stock, so I'm going to add it to my portfolio. So, I mean, there were probably people out there buying Fastly at 130. I mean, this Fastly had no business being up at 130, even with TikTok. I don't think that stock should have been at 130. So, I mean, that sell-off was, I mean, it was justified because you lose your biggest customer, you lose 12% of your revenues. You know, the entire story changes. So, you know, instead of doing $500 million this year, you know, you might be lucky to do, you know, 450, or instead of doing 450, you might be lucky to do 410, something like that. So, yep, that was a brutal one. So, I mean, I know one of the questions you were going to ask me was my best trade and my worst trade. I mean, the stock I made the most money on this year was Tesla, and the stock that I lost the most money on was, I don't know. I mean, this was a huge loser, but I still think if I added up all the money I made along the way from trimming Fastly, I think it was still more than what I lost that day. But that was, I mean, if I had to pick like you know, my worst day of the year, that was it right there.
Gotcha.
I'm trying to think. I mean, I had a few stocks this year. So at one point I did own, I had a small position in the springtime in Smartsheet. And I think I had like a 2 or 3% position when this drop happened. So that, you know, and then I cut it right away. I was out the next day. I had a small position in this one, Arcturus. That
just dropped like a rock very recently.
Oh my God. Yeah. So I had
50%.
Yep. I had it back here in like May. So I think I had a 1 or 2% position when that drop happened. So, I mean, it was painful, but like it was such a tiny position in the portfolio. It didn't, I mean, this one has just been look at these drops there, but then this rally, like, I mean, you could have made a ton of money on this stock, but then, I mean, so I know ARK, this was like a big position for ARK in their, I think, genomics portfolio. So, I mean, that ETF, ARKG, was down, I think, 6 or 7% yesterday because of this position. So, Yeah, 50%. It's almost 60%, right? From 100.
Yeah.
Holy shit.
Yeah. And
Wow.
and overall, I'm looking for stocks that have a history of gap ups, not these gap
Right.
downs. Because I find, I mean, you're much more likely to have a gap up if there's been some recent gap ups. I mean, GRWG started a lot of these great stocks. Yeah, pins start with a huge gap up, and this is often a good entry point, right when all those institutions are piling in. I mean, you had to sit through that, and I was trained this within that. But this is a sign that institutions have changed their mind and maybe are underweight in a stock that they have to buy.
So I remember I got into Pinterest right after this gap up when you did a video on it,
Mm-hmm.
and that got me into it, and I've been holding it ever since. I mean, I've trimmed it a couple times along the way, but I mean, it's still a 3 or 3.5% position in my portfolio. So, I mean, and there's really no reason for me to sell it yet. I mean, I mean, they're still looking for 50% revenue growth this year. Expanding margins. I know they send a lot of business over to Etsy. And then you throw in the Bollinger Bands.
Yep.
So, I mean, it's really, I mean, other than this big pop here, I mean, it really hasn't given you any reason to trim along the way. So, I mean, I've just I haven't really trimmed from what the Bollinger Bands have told me. I've more or less just trimmed, just, I don't know, when it got into the 70s last week, I just felt like it was due for a pullback, and it just had such a nice run. So I think I sold some around, right around here, 72, 73 range. But I mean, if it gets back down here, I'd probably start to add it again. I'd probably, if it gets back down to like 65, I'd probably start to add it back.
So you use technicals a lot more than I guess I was thinking you did, because you're looking at these where it's extended or pulling back to this potential support areas.
Yeah. I think, I mean, I don't use them as much as you do probably, but I think the more that I use them, the better it makes me. Especially with, I think especially so this year, right? I mean, almost any of my growth stocks that I trimmed, I ended up regretting it because most of them just kept on marching higher. But even when you're trimming a position, oftentimes you're taking the proceeds from that sale and you're adding it somewhere else. I mean, it's not like it's just sitting in cash and collecting dust. So, I mean, as I say, I mean, while some stocks are zigging, other stocks are zagging. So, as one stock might be, poking through the Bollinger Band and, needing a trim, another stock might be bouncing off a 20-day or 50-day moving average and ready to get some additional capital added to it. So that's kind of how I try to play it, right? Try to trim the stocks that are getting frothy, add to the stocks that are, pulling back to some support, and just kind of moving capital around that way. And, over the course of a year, I think you can add a lot of alpha that way. So.
Absolutely. And do you mind bringing up your spreadsheet where you have all your weights for your positions? Because I do want to ask you about how you decide what weight to give each stock. And I guess you talked about your kind of moonshot positions, which were just kind of tokens, so you're keeping an eye on it. But how do you decide which is a core position in your stock and which maybe has only a 3-5% allocation?
So, I mean, my moonshots. So I go in and out of moonshots. I mean, one week I get all excited about these moonshot companies, and then we get a sell off, and I think, okay, crap, I need that capital to, go add to my higher conviction name. So then I end up, selling off the moonshots and taking that money and adding it to, CrowdStrike, C Limited, Square, etc. And I mean, at some point I might get out of the habit of that, but at least right now I feel like, I don't know. That's just that works. That strategy works better for me when times get tough. I need to bet on the stocks that I have the most conviction in. But so a couple smaller names I added today. I mean, you can see the bottom of the portfolio. I mean, these are, I'm not even sure if they're 1/10%, to be honest. I didn't even do the math. I just added them in here. So these are stocks that I'm doing some due diligence on right now that were mentioned. When I posted on Twitter last night, I was looking for some new stock ideas for my newsletter. These are 5 or 6 of the names that came through out of the 200 or 300 that people mentioned that I thought looked the most interesting. So I did some due diligence last night. I did some due diligence this morning on these names. So I took very, very tiny positions just to get them on my main screen, like I said earlier, so I can start to see them start to see them trade throughout the day, maybe add some limit orders on a couple of them. I think a couple of these names like Clean Spark had a little bit of a pullback today. So CFII, I'm not even sure what that stands for. It's obviously a SPAC, but they're merging with View Glass. So I've known View Glass for many, many years, just because when I was doing SoundGuard, you're sort of in the construction industry. So you talk to a lot of architects and designers, you come across all these other products that are, being adopted by the industry. And that was a name that kind of always stood out to me. So I hope someday they could go public. And I think this is one of those stocks that if you want to, it's a play on not just I guess you could say the rebounding of the economy, but also like the rebound in new construction. So, I mean, if you go to their website, you can see what they do. I mean, I think they actually call it like AI powered glass. I need to read up more on that, but it's like self-tinting glass. So it's smart glass. The idea being that, when the sun's out, these windows are going to like tint themselves. So you don't need shades. They're super energy efficient. So, I think there was one example on the website where I don't know how big the building was, but it said it would cost, I think, $3 million to install, the View Glass, across the entire building. And over the next, I don't know if it's 10, 20, 30 years, they would save like $30 million, wow. Just in heating and cooling expenses, and then not having to, purchase all the blinds for all the windows. So, it's a much nicer, cleaner look as well. Like if you don't have to have these big, ugly blinds on every window, and you can have like this self-tinting smart glass. It's pretty cool. So
yeah, that's cool.
I think over the next, 2-3 years, as the economy rebounds, as we start to see new construction come back, that's the type of company that might benefit from it. So I might be getting a little bit early, but I usually say I'd rather get in early than late. So.
Absolutely. And if you don't mind going back to TrendSpider, I do want to ask about how you handle drawdowns. And I want to hear specifically how you handled the March crash, whether you raised cash,
right.
Trimmed your positions.
So I'll just say, so I would say, generally speaking, the larger the allocation of my portfolio, it's typically a combination of how bullish I am on that stock, but also how defensive it is, I guess, in terms of if we get a big pullback in the markets, I think that stock will hold up better.
Gotcha.
Even though I think Mohawk and, let's go through here, Upstart and a couple of these other smaller stocks might return, might put up bigger returns in 2021. If we saw a correction, I would expect them to pull back way more than a CrowdStrike or a Square or a C Limited. So, I have to try to keep that in mind. If we do get a drawdown or pullback, which of these stocks is going to hold up the best while also still giving me some upside in a bull market. So,
gotcha. And what's your psychology during a crash or a huge drawdown? How do you look at that -6% on the day or whatever it is, and make sure you're staying objective and following whatever plan you set out, and make sure you're managing your portfolio the right way, basically?
So it's a good question. It definitely depends. Because I went through the financial crisis 10 or 11 years ago, I think I remember how bad it was and how prolonged it was. So I was actually expecting that in March, as they shut everything down, as the gym was closed, as nobody's traveling. And I'm thinking holy shit, the economy is going to get freaking hammered. The stock market is going to get hammered. I remember the S&P going down 55% in the financial crisis. And I thought, this could be worse than that, right? Who knows how bad this pandemic is going to get? Who knows when they're going to actually get to reopen things? God knows how many jobs are going to be losses, how many restaurants are going to close down. I didn't think 11 months later we'd still be dealing with this, to be honest. But I also knew that the average time for a vaccine to come to market was many, many years, not many, many months. So I was mostly out of the market in March. I was pretty much all cash as the market was collapsing, because I thought, and there's actually text messages that I was sending to my buddies at Fidelity. And I'm like, dude, the S&P is going down to 1,600 watch. So I thought we were going way farther down than we went because I didn't expect Powell to come in so quickly and inject all of that money and stabilize the credit markets. So I was basically out of the markets in cash. So when the market bottomed, and I can bring up the SPY. Let's go back. Turn off the Bollinger Bands. Yeah, I mean, so I forget when I got out. I mean, I got out pretty early. So maybe somewhere around here, like late February. I mean, and then by the time this thing bottomed, I don't think I got back in until early April. Mm-hmm. So I clearly missed the bottom here. It rallied, came back down, and then I think that's when I got in somewhere around in the first week in April. Mm-hmm. And then also, I mean, this was also when I was running my company full time up until then. Mm-hmm. I was 50, 60, 70 hours a week, whatever it was. I mean, I was busy, running SoundGuard, managing sales reps, talking to architects every day, talking to the dealers every day. I was not doing a lot in my stock portfolio. I was not, set up with multiple screens, trading my positions, spending hours and hours of research and technicals. I wasn't doing any of that because I was mm-hmm. focused on my company and trying to build a, 20, 30, $40 million company at the time. And then once it became clear, right around here, like within a couple of weeks of this thing, starting and the lockdowns happening, it became pretty clear that my company was not going to come through this very well. So, all my sales reps were basically terminated at that point. I could tell, I mean, the calls from the dealers stopped coming in, because construction was freezing up and, I'm emailing the hotel people. I'm getting emails back that say I'm furloughed for the next 6 months or whatever it is. I'm like, oh my God, this is going to be bad. So I pretty much knew at that point that SoundGuard may not make it through this, or if it did, it would take, a while for it to actually recover. So down here is when I actually started. I'm like, okay, I got to start putting more time into my investment portfolio because my income for the year just disappeared. So the only way I'm going to be making any money this year is from my stock portfolio. So I actually pulled some money out of my company that was just sitting in cash doing nothing, since like if the company's not going to be doing anything, there's no expenses, no one has to get paid. So I might as well pull some money out, actually pay myself a salary and put that into my investment portfolio. So I started paying myself like every few days out of my account, adding to my investment portfolio, and then just, trying to kind of pick up where I left off, literally 10 years ago. I mean, mm-hmm. I really was not that active in my investment portfolio the last 8, 9, 10 years because I was so busy doing other things, trying to grow businesses, raise capital and all that. So, it's been the last, 10, 11 months that I really got back into this seriously. But I mean, I obviously have a background in the business.
Absolutely. Yeah. For me, I think I was able to get out pretty close to where you did just because it was breaking those key moving averages, and there are distribution days, which is kind of a CAN-SLIM term for big drops in the indexes on high volume piling up. So there are the signs that there could be something like this. We didn't know how deep it was going to go. And then we actually had the follow through day signal right basically where you ended up getting back in right after that second kind of pullback. So that's very interesting that we're kind of lining up on those timeframes.
So one of the things I did around here, which actually worked out very well, is I bought that
FNGU.
Yep. Yeah. the 3x leveraged, the FANG ETF, with Tesla and Facebook and Google, Amazon, Apple,
NVIDIA.
NVIDIA. Yep. And then Baba and Baidu. So I rode that thing. I mean, at one point, I think it was like as much as a third of my portfolio. But I mean, I think I rode that. So this is where I made a mistake, where I got into that, call it a 5 or 10% allocation in April. And then obviously it just became a bigger part of my portfolio as it rallied. But, I let it rally all the way up to this point, and I didn't, I hadn't trimmed it at all. So I got hammered and then hammered again. Let it rally, got hammered. So, and like I rode it all the way down. So I used it to make some money, but I didn't I don't know. I didn't manage that position as well as I probably should have. So that was a lesson learned as well.
What's your mentality when you suffer those big pullbacks? What are you thinking?
I mean, I'd like to say that I learn a lesson from each one, although I think the lessons we should learn, I don't know, are always so obvious at the time, or at least not obvious enough or painful enough that we don't make them again. So, I wasn't using any margin in this rally because I was just afraid of another big leg down in the markets. And I'm still surprised that we never got it. I mean, I'm still surprised that I thought we were going to come down and retest these lows at some point. And I'm shocked that we didn't. So there was no way I was going to use margin, with that thought in the back of my mind. So, I mean, I was still pretty bullish, as the Fed and the Treasury got more aggressive with their fiscal packages and whatnot. I felt like the markets were going to rally. And then, as it became pretty obvious that our pandemic winners, our cloud stocks, our e-commerce stocks were, really, really disrupting these industries, I stayed pretty bullish. So I did start using margin somewhere probably early summer. So when that September sell-off happened, I got hammered pretty hard because I was on margin. And I kept saying to myself, okay, if I get back on margin or if I leverage up again, I'm not going to let myself get to that point where everything looks frothy. I'm levered up on margin and I'm just asking for another, nasty pullback. So I did learn my lesson, and, we got that big pullback. I mean, the Pfizer pullback was there was no escaping that. I mean, it doesn't matter if you want margin or not. When that Pfizer vaccine news came on that Monday morning, Peloton was down 20%. I mean, that was just Zoom was probably down 15 or 20%. I mean, that was an ugly day. There was nowhere to hide for growth stocks. So, but even over the past 2 months, I've managed my margin pretty well where, I don't let my ego get ahead of myself. I don't let my positions, like I said, get too frothy. But I mean, the other thing is I try to, as I've been able to generate some income for myself and as I have money coming into my account every week or every other week, I don't mind the pullback so much because like if I have money and I know I have a big chunk of cash coming in next week, like even though the sell-off the last 2 days hurts my, month-to-date performance, my year-to-date performance, the fact that I have a chunk of cash coming in next week, part of me almost hopes that the market does pull back another 5 or 10% before that cash comes in so that I get to buy some of my favorite stocks at cheaper prices. So, and I mean, this too. I mean, any good bull market needs to have some breathers along the way. You need to get some pullbacks. You need to get some washouts. So, I mean, I look at pullbacks as just, at least up until now, over the past 6-9 months, as just healthy, normal corrections. A little bit of, a dose of reality for all those new investors that don't know what a pullback looks like or how, painful it can feel. And I think FinTwit is a good example of when you start to see all the rocket emojis coming out on FinTwit, you know it's time for a pullback.
Yep.
So.
Absolutely. And I think we're getting down to the end of it here. This has been great. I guess the last main question I want to ask you was, are there any either technical or fundamental red flags that you watch out for when it comes to your positions?
Ooh.
So something that would just make you exit the next day or something like that.
Not technical.
So RT, even given a drop like that,
which one?
ARCT,
oh,
the one that.
Oh yeah. So I mean, and so this is one reason I'm no longer even going near this industry, right? I mean, back when the whole, there was a race to find the vaccine and nobody knew, would it be Moderna? Would it be, one of these therapeutic companies? So I owned a few of them. I owned INO. I owned Moderna. I owned, I can't even pronounce the name, Arcturus. So I owned 3 or 4 of them, as like 1 or 2% positions each, just to try to, play that vaccine development. And then after ARCT burned me, I'm like, you know what? And I mean, I did make some money on Inno and Moderna, but I sold them way too early. I think I got into Moderna back in like March, or well, I guess not really March because it was out of the market, but April, probably somewhere in here. I probably got into Moderna somewhere in like the low to mid 30s. And then I got out of it like right around here. So, I mean, clearly the stock has doubled from, almost tripled from that point. So, I did leave some money on the table, but I felt like it just wasn't worth it. I mean, there was 10 or 15 companies going after the vaccine. No one knew who was going to get there first. There was just months and months of development and trials and, FDA approvals. And at the same time, like, are these companies even going to make any money on the vaccine? And look what happened to Moderna, right? I mean, Moderna, after they got approval, like, look what's happened to the stock since. So it was like, buy the rumor, sell the news, like perfect example of buy the rumor, sell the news. You ride it all the way up. And then as soon as everything good is out there, everyone sells it, like just crazy. So I've just realized that I'm not the right person to pick biotech or pharmaceutical stocks under any circumstances. So I have approximately 3 or 4% of my portfolio in ARKG, and I would just rather have Kathy and her team at ARK manage that chunk of my portfolio, and I can focus on other industries that I'm more familiar with. So
yeah, they're fantastic over there.
Yep,
definitely.
Great job. I mean, I follow them on Twitter. I read some of their research, but like when it comes to, genomics and all this other stuff, I don't understand it. Gene editing, gene testing. I mean, I think it's cool. I think it could be the future. So I want to be in it, but I don't want to be picking my own positions. I don't want to decide whether I should be owning, Editas or Twist or, one of these other, Flugent. I mean, there's so many of them out there now. I can't even keep track. And most of them, I mean, a lot of them aren't even, they're not even generating revenue yet, and none of them are profitable. So it's like, these are all very, very speculative companies by themselves, which is another reason I'd rather own them as an ETF. So you get that, that diversification. So, you're at least able to manage your risk that way, because, I mean, look what just happened to ARCT, right? I mean, it just dropped 50, 60%. So if that was like your one biotech or genomics company, you just got your ass handed to you. So.
Absolutely. And what about fundamental, like management change, or the company announces they're changing directions? Would that would that change your thesis of the company, and would that change your allocation?
I mean, so I'm just trying to think of examples this year where something material changed with the story or the fundamentals. I mean, the one that obviously comes to mind is Fastly, right? I mean, when you lose your biggest customer through no fault of their own, right? I mean, Fastly didn't do anything wrong to lose TikTok. That was just strictly a political battle between Trump and China. So it sucks that Fastly and their shareholders had to take the brunt of that. But I mean, that's the way it goes sometimes. So, certainly that changed the story for me, where Fastly is, let's see, it's 1, 2, 3. I don't think it's in my top 10 anymore. Oh, actually, let me see. 1, 2, 3, 4, 5, 6, 7, 8, 9. No, so it's like number 12 or 13 in my portfolio. So, I mean, this summer, obviously, and then leading to the fall, it was it was a top 3 position for many, many months. But it's just, once the story changes that dramatically, if a CEO, I mean, it depends. Like, I mean, I don't know. I mean, I'm not in Tesla anymore, so I'm just trying to think if something happened to Elon Musk, or he decided to, go to Africa and disappear or something. I mean, I guess that would probably change the story. Although I don't know if it would get. I mean, these large companies. I mean, they're in most cases, no one person is bigger than the company, anyways. So, if the CEO of C Limited, Forrest Lee, decided to step down. I mean, as long as he promised not to sell his shares, right? I mean, that's a little bit different. If the CEO decides to step down and they own a huge chunk of the company, and there's the thought that they might liquidate all their shares, that could create a lot of pressure on the stock. So in that case, I'd probably be out. But, I mean, if there's some indication that there's going to be a huge drop off in revenues, where some product or whatever is discontinued. I mean, like I said, I don't get into like pharmaceutical. I get into medical devices a little bit. So, I mean, that would obviously change. Like, so Nanox is one of my, I call moonshot companies, right? I mean, they're pre-revenue right now. They need to get FDA approval for their machines. if suddenly we wake up tomorrow morning and it finds out that they got denied FDA approval, I mean, the stock would probably be down 50% because of it. But at that point, I'd probably just cut my losses and get out. So.
Gotcha. Awesome. All right. So the last question I always ask is, do you have any motivating words for new traders / investors? What can new investors do to shorten the learning curve?
Good question. And I know you were going to ask the book and podcast, the book question too. I mean,
oh yeah.
I mean, I'll be honest, I don't read a lot of investment books over the years. I've never really found a lot that, kind of persuaded me, I suppose. I mean, one book I did read recently or listened to on audio was Chris Mayer's book, 100 Baggers. So that's pretty good. It's on Audible. I think it's like 15 or 16 bucks. It's a pretty easy listen. And there's some good stuff in there. I mean, one of the examples that he uses that I really like is Monster. So Monster Beverage, and this is one reason I own Celsius, but Monster Beverage has been, I think, one of the 3 or 4 best performing stocks over the last 20 years. And I mean, it's up like 100,000%, literally. Yep. It's like ridiculous. But I think there was a 10-year period where it was 100-bagger over 10 years. But in that 10-year period, it had, I believe, 10 pullbacks of at least 25% and at least 3 or 4 pullbacks of 40%. And even with all those pullbacks, it still went up 100x in 10 years. So, not that I'm always looking for 10 baggers, but I feel like it did sort of change my mindset that if I am going to try to find these small cap stocks that could be 10 baggers or 100 baggers, you got to stick with them. Like you can't get, a 5, 10, 15, 20% pullback can't scare you out of the position because you may never get back in and you may never see that big, 10x, 20x, 30x gain. So, I mean, look at Shopify. Shopify came public at like, a $3 billion market cap 6 or 7 years ago. Now it's 140 billion. So, I mean, you find the right stock at the right price and you got to find a way to hold on to it regardless of the, the volatility and the pullbacks, assuming that the story stays the same, the fundamentals stay intact. And that's what Chris talks about is, in order to get these 100 baggers, you got to find, he called it, I think, the twin engines, which is revenue growth or earnings growth and then multiple expansion. So, and I think right now, like, that's why I like a stock like Mohawk, that it's growing 50, 60, 70%. And then I believe you're also going to get some multiple expansion. So right now it's trading at like 1x sales, which is crazy. And I think over the next couple of years, you might see that multiple expand to, 2x sales, 3x sales, 4x sales. And then you start to, this thing turns into a 10 bagger just off that. So, I mean, motivating words. So, I mean, start small. Don't think that you have to hit a home run on every position or every trade. And I would say, there's so many things you're going to learn along the way, but one of the biggest lessons, especially that I learned this year is, and I sound stupid because even though I do trim my winners, they're also still positions for me, but don't trim your winners just to add to your losers. So I think too many people do that. Like they have a hard time admitting that they bought a stock and it went down and they don't want to be wrong. And they're just, maybe they have too much conviction. Maybe it's their ego and they just keep feeding that stock as it goes lower and lower. And it turns from a little loser into a big loser. And, that's how you ruin your portfolio. That's how you ruin your year. So, you do have to know and learn how to feed your winners. And cut your losers, like admit when you're wrong and get out of a stock while it's still a small loser before it turns into a big loser.
Absolutely. That's fantastic advice, I think. Jonah, thanks so much. It's been great getting to talk to you, hearing how you view the markets and analyze different companies. Everybody watching, I hope you guys enjoyed. And if you did, please remember to leave a like down below and subscribe if you want to see more videos just like this one. You can reach out to Jonah on Twitter. I'll have his links down below in the description. Thanks again, everybody. And I hope you guys have a great rest of your evening. I'll see you guys in future videos.
Thanks, man.